Alexis, what do you know about mortgage-backed securities?
Mortgage-backed securities?
Yep,
Nothing.
it's a big deal in the finance world. Okay, great.
Okay.
So you got a mortgage, Alexis, and you don't. I forgot about that. I have a mortgage, and sometimes
Way to rub it in, Luke. Jeez.
I know. Looking, but okay.
So you have the. Oh wait, you don't. I'm the only one that does here. The two plebeian renters.
the thing is that money doesn't always end up actually back at the bank at which I originated the mortgage. Sometimes, and very often, they'll go ahead and sell this asset. I mean, you can imagine like a loan on a bank's balance sheet is an asset. It's a promise of like future cash flows, right? Now, Alexis, what a bank could do is they can turn around and they can take that and sell it, and they can give it to somebody else.
Like in the loan comparison to Treasuries, there's one borrower and one buyer, and you've got one security. With an MBS mortgage-backed security, someone takes a bunch of loans, a bunch of borrowers, and then puts them all together.
Okay.
And then a bunch of people buy a piece of those bunch of loans. So there's
Okay.
many borrowers and then many lenders, effectively.
Now, mortgage-backed securities, those were kind of a big deal. Everyone sort of learned about them after 2008. They were held by a lot of investors, and all of a sudden, it became clear that no one really knew what they were worth anymore because, like, the underlying mortgages or the underlying cash flows that came from them were suddenly uncertain. Now, what I wanted to introduce today, imagine we got a new class of securities coming in, and those are going to be like compute-backed securities. And that's sort of what I wanted to talk to you guys today about. What I did this week was to try to get a better understanding of just the economics of what would be underlying these new things of securities. I'm going to call it a compute-backed security, kind of like a CBS, because that's really ultimately the source of the cash flows. The key thing with all these securities is anything that generates a regular cash flow, I think, can be securitized. They've got securities for all sorts of different loans. It's not just like the mortgage-backed ones are the biggest, but you can go into like commercial real estate, right? Those loans, but you can also go into like car loans or auto loans. You can go into student loans. Okay, these tech companies now are funding this whole AI thing. And that's because people will lend them hundreds of billions to put into okay. So you are Lexi Poo, and you want to start a business. You want to be one of these, AI compute. You want to get in the game, okay?
The latest hyperscaler.
Lexi Poo Compute. But the first thing you got to do is convince your financiers, right? The big banks. We're going to call that Joe. Joe is going to be one of these private credit funds, right? And you're going to go to him with this model, and you're going to say, hey, Joe, do I got a plan for you?
Let's hear it. The financing doesn't come cheap, but let's hear it.
And you're going to walk him through your business plan. Now, the first thing you got to do is you got to give him a couple assumptions. Right now, we're looking at a cost of compute of about $3 per GPU hour. Okay? This is a little bit of a weird metric, but just work with me here, okay? Next thing is we're going to be conservative, okay, Joe? We're going to say that the factory utilization of our AI factory is going to be 80%. Now, that's low. We really think we're going to be doing 95%, 24 hours a day. But, we want to be conservative here. We'll call it 80%. This next thing sort of touches upon the actual mean lifespan of the GPUs that we bought. So we bought a whole bunch of H100s. I'm thinking that we need 25,000 of them, okay? Each one of those costs $30,000 for the total upfront expense of about $750 million. Now, the thing is, some of them die. There's sort of an infant mortality going on there. But they're quite dependable. I'm going to say the interest rate on the financing, 10%, okay?
That's friends and family rate, too. Keep in mind.
Joe's going to be really nice. He's going to give us to a 10%. Remember, the risk-free rate right now is, like 5%. What do you think, Joe? For
I should be doing something. 12 or 15 here, but we'll do 10. We'll see how the first year goes.
I think the sort of the life of this venture, call it 5 years, right? Now we want this thing to keep rolling over, But again, let's just be conservative and say we're going to see what this looks like over that period. Lexi Poo, you've got rich overnight, okay? And you're going to say, I'm going to put in 10% equity, okay?
Skin in the game.
You got to get some skin in the game.
You take the first losses, pretty much.
Right. And then just bear with me here, but like the operating costs, the electricity and the cooling and all that, we're going to say is $75 million a year. At over the 5-year period, maybe half of those, like I said, but roughly the mean lifespan of these things, half of them are going to need to be replaced. But all in all, I'm looking at a pretty good increase in equity. And I'm talking about a CAGR, annualized kind of growth rate of about 65%.
Decent starting point. Yeah. I mean, I usually don't get out of bed for anything under 75, but sure.
Yeah, it's really good. So, but you can imagine, just to take a step back from this little game plan, this is kind of the discussions that's happening right now. But what the financier is going to do is going to be like, look, you got to give me a range of this stuff. Where are your risks? What's the problem here? So with this model, we can look and we can run like a sensitivity analysis. And we can say, if we start tweaking these, what screws up our profits more than anything else? So you just bump up all of the assumptions up by 10%. What gets the biggest hit to the bottom line? And the answer is going to be the price of compute and the utilization. So if the price of compute goes down, and that could be because the supply took off, maybe the people don't want it as much as they thought they did, or whatever it is.
Or AI becomes far more efficient.
These are the kind of things that keep Joe hesitant to lend you any money, Alexis.
Got to protect my 65%.
The other thing that's kind of interesting is what happens when you start adjusting the mortality rate. That's pretty important, but it's not super important. So if we dropped this the scale, which is sort of a rough indication of how the lifetime of these things are, let's drop it down to 5, and we can see that instead of 65%, growth rate, we're down to a 62. If you take this thing down to 2.5, now all of a sudden, bam, you just kind of got your total equity increase over those 5 years just got cut in half.
Seems pretty risky.
Yeah, this is the gray sky scenario.
I'm suddenly not so willing to lend anymore.
Exactly.
You gotta risk it for the biscuit.
But then you go, hey, but we just as easily we could go up to 90%. This is what I really think is going to happen.
Oh yeah,
bam!
I'm ready to risk it again.
Yeah. The other thing that's really interesting is the cost of the H100 is a really big deal, as you can imagine, because you are going to have to replace these things over time. So one thing I didn't see really people talk about too much, you start adjusting this number and it's almost half as sensitive, so to speak, or half as important as sort of our main numbers. Unlike other mortgage-backed securities where it's you got a bunch of houses and there's sort of inherent value in the house or the land, maybe you can foreclose it and stuff like that. With a venture like this, so much of the risk is also just in the supply of these H100s. Who knows what else could happen and could really mess that up, right? I mean, if China invades Taiwan and all of a sudden upstream the foundries and stuff, and now all of a sudden Joe's venture and his investment, because China does some geopolitical power play here, just became under threat. So now Joe's got to manage geopolitical risk because of this stuff, which is not something he needs to do with mortgage-backed securities. It was interesting to run this just to see really where the biggest risks are. Price of compute, utilization, the actual life of the H100s is not that important, not so much as important as the cost of the H100s, I think. In my opinion,
I am a big believer overall in all this. I mean, I think what you're showing here, Luke, is just how far-reaching the assumptions are that you have to make whenever you're putting a deal like this together.
That's fair.
This is literally building the future right now. Projects like these. I'm a big believer that this is going to be AI is just getting started. We've only seen the very early days of it being worked into basically everything yet. A lot to go still. So in these early days, I would definitely support this. But yeah, I got to say that geopolitical risk, it's really the dark horse there.
Geopolitical risk. That's the one where like global issues go to shit, and then now are.
If you're building this data center, you got to know where these chips are built, right?
Right.
And it's like 90% of the world's chips are built in Taiwan. I just made up that number, 90%, but a huge percentage.
Musk is all about trying to build the future, and he recognizes that there's a current bottleneck here with actually manufacturing the chips. So I think it's a combination of Intel, Tesla, and SpaceX are sort of combining their forces to try to do a terafab, I think is the project, is to try to bring that stuff on shore. But my point is, like, as an investor, this is not something an investor in MBS doesn't think about that stuff. But now they've got all these other factors they have to keep in their head. But I mean, otherwise it looks pretty good. I mean, these growth rates are like out of control. And like, obviously everything is just built on assumptions. Like, as somebody who works with models at work, I promise you, if you were to lean towards any way or the other, you can make a model to support whatever you want. It's all about the underlying assumptions.
You start with the answer you want.
You start with the answer. Yeah, sometimes it's how it feels. Sometimes, yeah, right.
That's how you build a pitch deck.
Yeah.
So take
a little dirty secret.
Take notes, Lexi.
Anyone who makes models, and that's like why it's just, I'll make a note just to kind of protect myself. That's why it's so important to have, and what regulators ask for is you got to have a very strong like second line of defense at a bank, for instance, exactly for this reason. That's like their job, is to make sure that
nobody's fudging the numbers too hard here.
Like, they're not like, I want this answer, go justify it in the model. It's like, no, you have to really defend these assumptions really, really well.
I'm sure.
But still, building a model like this is, I think it's instructive because it shows you where your risks are. You can quantify them. That also means, like, going forward, if you see the price of compute start to drop, there are going to be people running these data centers that are going to be sweating.
They are, but Luke, there was another piece of news just late last week, actually. CME came out and said that they're going to be launching futures contracts tied to the H100 and B200 prices. So basically that exact metric you were talking about, people will be able to hedge that. Yeah, I think starting in October.
Well, Alexis, this is also a very important bit. What he's referring to in the futures market, well, you can, like, there's a financial product seemingly for anything. And even nowadays with these prediction markets, you can start putting in money about like what the weather's going to be.
Let's just leave prediction markets to the side
here.
here.
That out here. But the point is, like, one of the big strengths of finance and why it exists, people think it's like some sexy thing used, to speculate and stuff. And it is used for that. But really, it's a tool to help manage risk. Mm-hmm. And a futures market is like, if you, Alexis, you grow corn, okay? You don't want to be like your profits completely at the mercy of whatever corn is going to be 8 months from now when you harvest all your corn and try to sell it.
Yeah.
So what you can do is you can go to the Chicago Mercantile Exchange and you can write a contract that someone says, in 8 months from now, I'm going to sell you corn for X price.
Okay.
Right.
Do you remember that scene from Ferris Bueller's Day Off where they're down there doing all the hand motions?
Oh,
I remember that. Yeah.
That's the CME.
So, Alexis, that's where the futures market is. Basically, you can nail down the price of something that you could either buy or you can sell in some time at the future. So what he's describing is like in my little example, when I said that you are exposed to changing prices in the H100.
Yeah.
Right? Because if it in the future goes up a lot, you're screwed, Alexis, as somebody who's running that AI factory. Mm-hmm. But what Joe just made clear to me that I did not know, thank you, Joe, is they're actually putting those products in the futures market. So now, Alexis, you can go and say, okay, I know I'm going to probably need at least, 10,000 H100s 5 years from now. Mm-hmm. Now I can write in the price. I can nail down the price of those 10,000 right now.
That seems nice. And then people will like buy that though? Like,
they have to provide it to you. That's the contract.
And there's someone on the other side of that needs the opposite. And so the point of the exchange is to bring those people together to smooth over the price of those assets and liabilities.
Yeah. You can start to see that the financial groundwork is being laid for kind of this AI future.
Yeah, it's coming in the derivatives market at the same time as the asset-backed securities market. Futures contracts originated for the purpose we talked about, for commodity production, to facilitate being able to sell your crops at a certain price, to buy or sell oil at a certain price. So a lot of the backers here, they're calling compute, that's the new commodity. That's the new oil of this AI era. And so having these futures contracts come out from the CME, the world's largest derivatives trading house, effectively, that's basically cementing that view that yes, like this is the new it feels sort of pedestrian to say, oh, this is the new oil or whatever, but that's really the case now. So this is such a critical number, the price of compute, that now people on a vast institutional scale need to be able to lock in prices here.
Do you believe, though, Alexis, that there is going to be this demand for compute? You personally?
I don't know enough about it to really like weigh in that much or that like responsibly in a case like this. My gut is I still feel a little bit like it's a trend at the moment. It's probably way surpassed that, and it's like, okay, it's here to stay. I mean, people can't stop talking about it, but I don't know. I have doubts. Like it hallucinates all the time, and all the
I just busted out my credit card today to buy like the higher plan for Gronk, because I'm like using it so hard, and I'm not even using like the high compute stuff. Like I'm not generating video. I'm just asking it to do like daily tasks. But in the future, you can imagine people are going to use it for making not just pictures, but like video, and then like high definition video. And they're going to ask it to make like games. And then it's going to be like games that render in real time. I think like there are some gaming developers that like right now when you go and talk, you have like these open world games and you have to go walk around. And sometimes you want to like talk to different, like what are called NPCs, non-playable characters in the game. All as of now, all of that dialogue is scripted. It's all like written and just coded in, right? Now imagine a game, and I think they're working on this now, where you can just like type in something, just say some random stuff to some random NPC in some game, and an AI will produce the response based on like some personality that they build into this. So that's like all coming. And we're just kind of scratching the surface, I think, now with just like language model stuff. When you start getting into video, I think like the demand for compute is just going to just absolutely take off, I think. So I like, and the other thing just at work, it's insane how like good it is. It turns everyone into an intermediate programmer at work.
Hold on, by the way, sorry to interrupt. Lexi Poo, I think we've got a little friend here on screen who's wants to come say hi.
He's really chatty, so this is kind of what
I've got a
expecting to happen at some point.
I've got a kitty too, and I'm a little upset that she's not as excited to be on screen.
Buzz actually loves the screen.
One other point I'll make has to do with why NVIDIA is maybe just the dominant player with chips. Because I always had the impression, and let me know if you've had a different understanding, but I always just thought NVIDIA just did like the most compute. It was just the best at it. It had the highest compute. But that's really not the only factor. Really, the most important metric is almost like the performance density, the reliability, the lifetime, right? You need to build up a software ecosystem and the power efficiency. So it's like NVIDIA is probably the best, not because it's got the best compute per se, but because it's economically just the best. Because you stick the assumptions into that finance model and it just comes up with the highest return. And now all of a sudden they can, that's why you just don't think to buy anything else. What do you think about that take?
I think they are just the best too.
But what does it mean to be the best? It's like I always thought like when you I got a NVIDIA graphics card in my computer. I've got a gaming computer. And when you talk about the best like graphics card, you're just talking about the most powerful.
What can play the most intense games, right?
Yeah, exactly. That's what it means to have just the best graphics card. What I'm saying, for the purposes of this, the best GPU is not just like the most powerful. It's the one that just is the most economic. It's the one that gives you the biggest return in that model based on the assumptions you put in there. Anyway, that's all I had for that model. Any final thoughts?
I think I want to do the deal, Lexi, but you had to give me one final piece of reassurance here that this is a good investment. What do you got for me?
That you can trust me. I mean, we just met recently, but I wouldn't lie to
Keep in
you,
mind,
Joe.
if you nail this, I might even give you 9% instead of 10%.
And I I think a fellow cat person, you know, how are you going to break that bond?
That's it.
I think we got something there.
I'm in.
That's
You know, business is built upon relationships. Relationships are built upon
Right.
mutual cat ownership.
Right, exactly. Yeah. Two cat people getting together. Great. That's it, Alexis. That
Look,
1%.
I can just feel the disdain in your voice here.
The 1% interest rate, just saved you like 50 million, maybe. Nice job, Lexi. Talk to me about what the hell is going on with the Treasury markets.
Don't even get me started.
Yeah, it's like all I see now, posting up there. So, Alexis, again, this is like the third week in a row we've talked about this, which is a little unusual. But you remember how we said that the higher the rates go on like the U.S. Treasuries, the more upset Scott Bessent is going to be. Well, they just hit like the highest number since 2008.
Yeah.
2007. Okay, so you did see that, yeah. So now the big talk is like, what's going on? People aren't buying U.S. debt anymore. Just like impress upon you, Alexis, sort of why this is exciting and why it's a big deal. You got to remember, the U.S. every week, the U.S. tries to go out and raise money. It's not like it's not an option. It's like it's living paycheck to paycheck every week. So imagine, Alexis, if you couldn't pay your bills, if you didn't go to like the bank and say, hey, look, I need to borrow some more. I need to borrow some more.
Hundreds of billions of dollars every week.
Every week, Alexis, they have to do this. They go to Treasury auctions, is what they're called. And they send out, bills and notes and bonds. Now, Alexis, what happens is now you're showing up at the bank and they're like, you know what? And they're kind of hesitating a little bit. And they're like, all right, I'll give it to you, but it's going to cost you a little more because I'm a little shaky. I don't really want to as much. How would you feel? And you need this money. You can't pay your cat food without it. And you're like, no, really, I'm good for it. I'm good for it, I swear.
So much.
And it's like, okay, fine. Yeah. Fine, but it's not 5% anymore. I got to give it to you at 5.1%. And you're like, okay, fine, I'll take it. Whatever. Okay? That's like the situation that the U.S. government is in.
That's Scotty B right now. He's basically talking to the world's investors. Listen.
Yeah. Doesn't have a choice.
Quit making me pay
to raise this money. If you don't, you can't pay your bills. You default. Okay, Alexis?
Yeah. Government shutdown.
It's scary. I mean, no joke.
Yeah, that is scary. Okay.
It sounds insane to me. Like I could imagine myself trying to go to the bank every week asking for more money. Like
that's how you really feel, Luke.
Yeah. So, but Alexis, you see like why this is a big deal.
Oh, for sure. Yeah. And now that you guys mentioned it last week, now I'm seeing it like everywhere. Now I can finally pick up on it. And now I'm scared. Yeah.
Good. Great. No, that's what we want to do here.
Scotty B's latest market intervention to try to convince everyone that rates shouldn't be going up more. So now like every other week now, every week, he's been doing something new just to do whatever he can to try to get it down. Like a month ago, it was that yen intervention. A couple of weeks ago, every quarter, the Treasury puts out basically a schedule of what kind of debt they're going to issue over the coming quarter. I'm going to do this much in really short-term stuff, this much in really long-term stuff. He kind of played with the language a little bit to say we're not going to issue as much long-term stuff, even though we have to, but he's just going to not do it. And now this week, he said, in fact, we're going to buy back that long end stuff. We're not going to not only not issue more, the Treasury is just going to start buying it back so other people don't have to anymore. It's getting so bad, the Treasury is now having to buy back its own long-term debt. And then today, rates went down whenever he said that, but then today it already reversed. They already went back up again. So it's like the big point that I see and why this is becoming an even bigger problem right now is that the market isn't really listening to him anymore. He's doing these really direct things to try to get the rate down. And usually they've worked so far for him throughout 2025. But now they don't seem to be working anymore. There'll be a short-term decline in rates in Treasuries, but then they go right back up, a day later or a week later.
So a couple of terms in there, Alexis, maybe it's not super obvious. In this analogy, if like you were the U.S. government and you went to the bank and you got to raise money, they don't just get like one big loan. So you can think of these like bills and notes and bonds, these things as a thousands or something of like little individual ones that are mature at different dates. So like you'll go to the bank and you'll say, I want $1,000 and I'll pay you back next week. And then I want another $2,000 loan that I'm going to pay you back next month. And then I want another $5,000 loan I'll pay you back in 10 years. So that's the short term versus the long term stuff. Now, what you can do is you can buy back the loans, which essentially is saying that you're going to prepay them. I got $1,000 I got to pay back next month. I'm going to pay it back right now. And that's effectively what he's trying to do with like the longer term stuff.
We can afford that, or
well, you just raise more debt. So you raise some shorter term stuff. You raise some shorter term stuff at a lower interest rate. And then you pay off the higher term stuff that's due in 30 years.
Longer.
It's not pretty. I mean, it's not like he's doing what he can, but ultimately it's a function of supply and demand, and he needs to raise a lot of money. And it's just tough when there's people who don't want to lend it to you that much at those lower interest rates. You can always raise more money. It's just going to be more and more expensive. And that hurts. It's like, because interest payments, we're already paying more in interest than we are for defense. It's insane.
And the total debt just hit 40 trillion. So we've also got that to sit with now.
For a little while in your head, it was like 30 trillion. That's like if someone asked what it was, and now it's like, oh, great, we got a new number.
It was 30 trillion for like a few years. I was thinking about it the other day. I remember back in high school, we had a chemistry book, and they were talking about, the size of molecules, right? And, the number of molecules in a small amount of, and there was one question that compared it to the U.S. debt in like a very snarky tone. And it was saying like, the U.S. debt somewhere around $7 trillion or something like that. And I just thought, I was like, oh, wow. Like how quaint. Like, what was the debt?
I wanted to introduce another segment here, which is, I think, finance people, we live in the future. What are some of the things we're kind of looking down the horizon and seeing what's coming? And like one of these things people are watching now is like, what's going to happen to the interest rates? If they start to go up, you're going to sweat. If they go down, maybe you can relax a little bit. But I think another one is the monetary policy meeting that's going to happen on September 18th. And this is in Japan, I'm talking, by the way. Keep an eye on Japan, what they're going to do with the rates. There might be a little surprise rate hike. And I think that'll say a lot, and sort of dovetailing off of what we were talking about last week and 2 weeks before. Like, who's going to win this fight? Remember that whole field of rakes that they're standing on? Anything they do, some other rake's going to slap them in the face. And I think there's such a push, perhaps, that they need to normalize these interest rates and start getting out of this debtor-friendly mentality and start getting into a more creditor-friendly mentality. Anything else, Joe? You got something you're looking out for?
Yeah, I guess the one thing, I don't know if this is something I'm looking out for, but I guess watching right now, you can tell I'm just really stuck on, treasuries and the debt and everything. One of the things I found really striking is that over at the Fed, Warsh's whole thing is to be not interventionist. I mean, I guess the opposite is, it's if you're not intervening in the market, you're participating in the market. Like you and I, we're all market participants. It's not unusual if we go and buy or sell a bond or buy and sell a stock. Those are financial markets. That's what you're supposed to do. But places like the Fed and the Treasury, they're overseeing the financial markets. So you say if they, there's stated things that they do in the markets, and things that they really shouldn't be doing. So they're a participant when it's like, according to their mandate, they're in the market. But whenever they start to bend the rules a little bit, then people say intervening. Like, after the financial crisis, all the quantitative easing, that was seen as a huge market intervention at the time. It's since become normalized, and so that's kind of my point here, is that the Fed since 2008 has been extremely interventionist. And with Warsh now, it's a big change. He says, you know what, I don't think this is very good. The market shouldn't be playing the Fed. They should be playing the market. But at the same time, Bessent is kind of flipping the script. He's becoming more and more active now, when usually the Treasury doesn't typically do that. He's not the first to do it, but it's been the first time in a very long time where he's been so active and just doing everything he can to try to push markets in the direction that he wants them to go. we've got this kind of competing signal from the Fed and the Treasury, the two most important institutions to the U.S. debt situation.
That's a great take. Yeah, that's a good insight, because we got two trains kind of heading towards each other. On the one hand, maybe three, not to squeeze the analogy too far, but we have to continuously raise more and more debt. And on the one hand, the central bank is saying, look, we're not going to buy it. Basically, just like, don't look to us.
Yeah.
Okay.
That's wants a lower balance sheet.
Yeah, they want to shrink their balance sheet. That's his big thing. He's the drum he's been beating. On the other hand, the treasurer, Scotty B, is out there being like, somebody's got to buy this stuff. Okay, so look out for those two things too. Warsh, I'm not buying the debt. And then Scotty B is the main salesman. He's trying to sell it.
And then that's something else that we talked about on this show a few months ago now, like a Treasury Fed agreement. So back in the 1950s was the last time they did this, but the Fed and the Treasury used to work directly together in terms of how they would issue the debt, how the Fed would interact with the debt. But after that, after World War II, they said, you know what, let's keep this separate. Monetary policy is its own thing. Warsh was talking about working more closely with the Treasury, but now he's taking a very opposite approach that Bessent is right now. So it'll be interesting to see if there's any kind of conflict there over the short term. Bessent's also funny because he's also has kind of a fiery temper too. So if he starts talking smack about Warsh on the airwaves soon, that'll be...
Scotty B, he's got a little diva in him.
He does.
He does. It's great.
Apparently, he got in a fist fight with Elon, in one of the White House meetings. So there's been multiple.
What? What are you talking about?
I thought we talked about this. So Elon was one, but there's been multiple times where he is either physically threatened someone or physically hit someone.
Scotty B?
In the White Scotty B. And so earlier in the administration, someone asked him this directly, one of the press, when they're doing a public roundtable thing.
Scotty.
And one of his responses was, he goes, well, Treasury secretaries do have a history of dueling. So he acknowledged it. It's yeah, I am slapping heads around, knocking heads around back here. And yeah, and apparently one of them was with Elon, early on in 25, whenever things were getting a little rocky with Elon. So yeah, Scotty B means
Elon's
business.
Pretty big.
Yeah.
All right. Damn.
That's also why I like him so much. He's just a badass.
The other thing, I'm kind of looking at this Clarity Act, kind of under that context. There's been a big wave of new banks. They're called de novo banks, which is just a brand new bank. I mentioned this because there's an Augustus National Bank that just got FDIC deposit insurance approved. And, they're targeting what else? Digital asset companies, AI tech firms, high net worth, individuals and stuff. Anyway, that's all I had for you today. This has been another episode of the Root of All Evil podcast. My name is Luke.
I'm Joe.
I'm Alexis.
And we'll see you next week. Thanks for joining us.
See you
Bye.
then. Bye.